But of course, Europe is not just a market for, in its own right, it's a great source of capital for the rest of the world. And of course, one of the countries in Europe which has been exporting capital into real estate, especially into Australia, for at least 10 years now is Germany. And you might want to tell us, Nick, a bit more about how the German funds are faring at the moment.
Yeah, they've had a pretty volatile few years. This chart shows the net cash flows flowing into the funds as a whole, or out of the funds as a whole. You can see that big withdrawal of money in October 2008 for understandable reasons. Clearly, as we came through the GFC, there were significant withdrawals, and quite a few of the funds did have to close to redemptions in order to prevent money flowing out too quickly. A significant proportion of those had managed to reopen, and we got back to a point where investors were saying, because the open-ended funds tend to buy pretty good property, investors were saying, yep, this looks like a good cyclical point at which to start putting money back into the market. However, although these are the most up-to-date numbers, what they don't show is what happened in May. A government minister, you have to love them, made a comment that clearly property in Germany still looked as though it was overpriced, and that the German open-ended funds looked as though they were overpriced. So maybe what we should do is just take an across-the-board 6% hit on capital values in that sector, and that all the German funds should just devalue. Oh, and by the way, one of the other problems is that people can get their money out too quickly. So what we should do is not really make them open-ended funds. We should put a much longer notice period on for people to withdraw their money, which, combined the two together, not surprisingly, led enormous numbers of people to immediately start shoveling cash out of the funds that they were invested in. So the funds that had been recovering and managed to reopen, immediately a load of them had to close again. The problems were not really within the funds. They were actually with someone who really shouldn't have been saying what he said, saying so, and he wasn't even authorised to say it. Since then, I have to say that the German government seems to be making it clear that that's not what they're intending to do. So hopefully what we're likely to see is funds flowing back in, and some of these funds can reopen again. But also bear in mind that the three biggest funds within the sector are still very much open. They've made a number of key sales just to demonstrate that they have got significant liquidity there, should they need it. And those funds are still seeing positive inflows. So hopefully it's certainly not going to be the end of the German open-ended funds moving around the world and buying real estate.
Yep, good. Okay, thanks, Nick, for taking us around the world, including a special focus on Europe there. It's time to come back home and look at what's happening in Australia and in Sydney. How do we fit in on the global scale, and what's our outlook? Well, I guess oddly enough, Australia has been through a fairly uncertain time, although most of it's been brought upon ourselves, and can be also brought back under control as well. I mean, we've seen a sort of a bumpy 12 and 18 months. Obviously, the GFC has been buffeting Australia, although we've been least impacted compared to other parts of the world. But there have been some big issues that have really concerned the property industry that may have happened or may not have happened. It's been a great time of uncertainty. The ETS, the RUD Bank, the mining tax, all these things are big issues that could really affect confidence and decision-making going forward. The Sydney Metro in Sydney, is it on again, is it off again? So it's been a period of great uncertainty, and I think now at least we have the opportunity, I mean this is a 12-month outlook, to look ahead and think, well, there is an opportunity for greater certainty ahead. I mean, we do have a new Prime Minister. We know that she will call an election pretty soon. So one way or another, we'll be into a new era. Hopefully that brings with it the chance for greater certainty. And in New South Wales, even more so desperately, within this next 12-month period, we'll be into the same situation. So we do have the opportunity to move into a much more stable and certain environment now. But there are still some issues to deal with. I mean, we really see 2010 as the sort of the bumpy year. I mean, Nick talks about the bumpy recovery worldwide. Well, we still have some of our own bumps to navigate, and especially with the very successful stimulus package now fading away, we do see some indicators turning down. We said this last year. We said, well, don't misinterpret these things. Some things are going to subside, while others are gently building up. And so it is a bumpy year this year. But thankfully, on the property side, asset values have bottomed, and what we're looking for now is a clearer direction, which we think there are some opportunities ahead for that to start to occur. Let's have a look at the employment situation in Australia. I think the one thing that stands out, the one important issue here compared to the rest of the world, is how the employment growth has picked up here already over the last 12 months. We've been into a growth phase of employment. Now, of course, the US has just bottomed. The downturn is still ahead for Europe. So we're at least a year ahead of the rest of the world. And ironically, some of the growth is even, some of the rates of growth are now starting to ease because we've come off that initial surge of activity. So we've got an employment base which is growing, and it's growing at a slightly lower rate now, but it's returning to trend. And this is one of the other things we're going to see over the next 12 months. Many indicators will be returning to trend. It doesn't mean they're dropping and they're falling down into a recession. It means they're going back to where they were before the stimulus packages had the effect. So I think you've got to be pulling the data apart and understanding what's really driving these sort of trends. But employment has been enormously important. It's been very important for the Sydney CBD office market. And it's interesting, when we look at our forecast for the market, we look back at what we said last year and we thought, you know what, they really haven't changed that much. Our forecasts are very stable, very consistent. We thought we'd go through some of the things we actually said last year and compare to what we're saying for the next 12 months. We said 12 months ago that the demand side contraction, which we were in the middle of 12 months ago, was now largely done. We said that 12 months ago, and indeed that's turned out to be the case. We've basically been in growth virtually ever since that. And now we know the leasing recovery is underway. We think it will push through into 2011, and the net absorption expansion will actually peak next year. We said that total vacancy would peak this year around 9%, and here we are, the middle of 2010, and we think that's exactly what's happening. In fact, our peak employment vacancy rate is now a little bit lower than what we were forecasting a year ago, thanks to that slightly better employment situation than we thought. We said last year, we went out on a limb and said that, well, rents would consolidate this year. They would start to grow in 2011, and they'll be spiking by 2012, given the conditions we thought would be prevalent at that time. Well, interestingly, this is one area where we've actually brought our forecast forward a year, because we're now really saying that, okay, rents are consolidating, but we see the spike in growth actually next year before rent growth returning to trend in 2012. So that earlier move into employment growth has brought our forecast forward by a full 12 months. Now, last year we called the CBD market, in fact you could say this about all the property markets, was the phantom cycle. There was just not enough trading activity to know where pricing was at. We really didn't know. It was a mystery last year. We thought that would be resolved by the end of 2009. We think it was, because there was enough trading activity to at least get a bit of a radar on pricing. And we think the stability has now returned to pricing, and incentives too have now peaked as well on the occupational side. We really looked ahead last year and thought, well, the finance industry was going to have to recover. It's interesting that it's really the only industry in Australia that's suffered a significant downturn, and it's the one area where you might see the kickback. We think that really has happened, and it's going to be important drivers still for the next 12 months here in the city. So in terms of our forecasts, we hear a lot in the industry about, well, show us the evidence. We're reading a forecast a lot. I think there's a lot of wariness about economists and forecasters at the moment, given especially what's going on overseas. But we looked recently at the amount of office leases that are signed every quarter. We did an analysis looking at the rolling annual level of leases signed. And I think this is a really good piece of evidence, and it really summarises where the market's at. So it says that on average there's about 200,000 square metres of office leases signed in the Sydney CBD every year. You can see how dramatically that dropped away in early 2009 and mid-2009. But since then, it's started coming back, and it's back at about 150,000 square metres of leases signed already. So in some ways, okay, we're in recovery. We haven't got back to where we were, but we're on the way. And I think that's a good summary, really, of how we see the markets at the moment. I think this is good evidence that should bring some confidence to occupiers and to investors and owners alike. So in terms of our forecast, what it means is that rolling that forward, we think our net absorption numbers show positive absorption this year, about 100,000 square metres, the same again next year. And ironically, starting to reduce a little in 2012 as the leasing options start to disappear. The configuration of space by then we think will be sufficiently restricted to limit expansion. On the supply side, we see a reasonable amount of space coming in this year, mostly refurbished stock, before that 2-year gap of major completions. And this is a really important period when we think vacancy gets its opportunity to reduce gradually, and that's the period, of course, when rents in these conditions should be rising.